Hello, good afternoon. Today on the Final Bar, sell-off right into the close, a similar theme to what we've seen a number of days in the last couple of weeks. Obviously, a big reaction to a lot of earnings, things like McDonald's, Hasbro, other selling off, but things like Biogen, Lyft, others jumping up pretty nicely. We'll unpack that. Also, the mailbag and some sector setups. Ladies and gentlemen, this is the Final Bar. Hello, good afternoon, everyone. Welcome to the Final Bar. This is Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a very rainy Redmond, Washington. Thanks so much for joining us today. And a number of you I know have joined us since we started the show a couple weeks ago. Really appreciate you tuning in. As always, just want to remind you, you can email us anytime, questions on the product, questions on the markets, on technical analysis, whatever. The Final Bar at StockCharts.com is the way to get to us at any point. And we read and pay attention to all those emails. We're going to unpack some of those in the mailbag segment in a little bit here. But really appreciate you tuning in. On that note, I wanted to remind everyone, I'll be speaking at the Las Vegas Traders Expo. This is coming up on November 7th through 9th, obviously down in Las Vegas. It's a great show. Hits on active trading and from a lot of different technical inputs, different speakers and experts. I'll be speaking Friday evening, 5 modes of mindful traders. We'll talk about mindfulness and discipline and how that should be a part of your preparation for an effective trading day. So look forward to seeing you there. You can register at stockcharts.lasvegastradersexpo.com. See it there on the screen and certainly check it out if you can get in the area. They do have a streaming option as well, I'm told, if you can't get to Las Vegas in person. So today, obviously, quite the move, and I would caution everyone. We call the show the Final Bar, and that's because today's bar, the final bar, the last bar on your chart, ends up being so important, and especially during the trading day. So if you brought up a daily chart of the S&P, this daily, this bar on the far right, the Final Bar, looked pretty positive at the open, right? In the first half hour, even couple hours a day. Sort of opening, trading higher. It looks like just a continuation of yesterday's session. Looks pretty solid. You're feeling pretty good about it. But again, the final bar, that last bar, is active until the close, right? It's not set in stone until the end of the trading session. And if you look at how it's evolved, any of you that follow candlestick analysis, do you know what this 2-bar pattern would represent? And maybe a little difficult to see because I'm looking at a bar chart, but if you're familiar enough, shouldn't make sense. This is actually a bearish engulfing pattern, right? Where you have an up close on day one, you have a higher open, but the lower close, and the range, the open to close range on day 2 engulfs the range of day 1. So on a candle chart, this would be a long, solid candle. That would be a long open candle or up day. And that in general tends to be a distributive pattern. That tells you the next couple bars, more likely than not, are going to trade lower. It's showing you distribution. Again, think of, yesterday was an accumulation day. Today is more of a distribution day with people selling their shares through into the close. So that short-term pattern and the fact that it occurred at the previous highs, the supply area we've talked about, really suggests the next couple bars should more likely be lower than higher. I remember talking with Steve Nissen about this. Steve really was one of the first, if not the first, to bring candlestick analysis from Japan, which is where it was originally found. And this was back in the 1600s. Rice traders used to actually use an early form of candlestick analysis to figure out when they were going to sell their rice at the market. And essentially, he brought that sort of style of charting to the West. And he always talked about how this, the pattern, 2 things you want to remember. Number one, what is the trend leading up to the pattern? So it's really only a bearish engulfing pattern if it happens after a rally, which it has. The second thing is, how do you know if that's wrong? And it's the peak of the pattern, right? So if we eclipse the high from today, which would be around 30.15 or so, if we're able to eclipse that over the next couple of days, that would basically invalidate that bearish engulfing pattern and suggest further highs. So sort of the base case, short term based on that, is short term, weaker rather than stronger. Let's look at the last 5 days. So I like to look at the 5-minute bars just for the last 5 trading days. Here's how the week ended. This was Thursday into Friday in the middle. This was yesterday, which gapped up on the open, and then just this slow and steady chipping away, stepwise motion to the upside. Here's today's trading. So we opened a little higher, really were sideways for most of the day until around 2:30. But then again, look at the last hour. And we've talked a number of times over the last couple of weeks how that last hour of trading a lot of times has been weaker. Just in the last 5 days, we saw that on Thursday, we saw that on Friday into the weekend, then we saw it again today. And what that usually suggests, again, just the way that institutions make their trades, that's usually what's going to happen in the last 30 minutes, last hour of trading. That's when big institutions are able to start moving some volume. That's what accelerates there. So really suggesting that there's profit taking in my opinion here in the short term. Now, what else can we think about from just a market summary, just sort of an unpacking what we've seen here? We've had a lot of single stock movements, and remember that the market is the summary of a lot of individual stocks and what sort of moves that we've had. So, for example, things like McDonald's, which I showed you in introduction, this is a name that reported earnings today before the open. You can see obviously more negative than positive. And again, we can go through the earnings numbers. You're welcome to review them. But for me, the chart is what you need to look at because that tells you how people are reacting to the earnings. So whether or not they beat earnings is irrelevant relative to the price, right? This shows you that clearly people are not optimistic about the prospects of McDonald's. So on a chart like this, how do you deal with it related to earnings? So a couple things. I would say number one, clearly a sell-off. So you want to see what sort of follow through you get on the next day. Do we have a continuation, or do we get buyers coming in liking the weakness, short-term weakness in McDonald's? The second thing is where we're at relative to support levels. So I'm looking back here to around 195 or so, 194. That's where we found support back here in May. That down to maybe the 192 level. That's sort of where we found support here at the beginning of May. That's sort of the next range you might look for. The third thing, though, is the 200-day moving average. And this sell-off today has brought us right to that key support level. So we're nearing an oversold region. We're right at the 200-day moving average. So does a stock like McDonald's hold the 200-day, or is this the next sort of step to a further downside? But clearly names like this have gone weaker over stronger. Hasbro's another name that came to mind. This is obviously much more of a gap down. McDonald's sort of a sell-off, almost a continuation of the last couple of weeks. Something like Hasbro is a real gap down, now gapping below the 200 days. So you want to see if it maintains that or not. But also there are a number of stocks going higher. And again, if you've not looked at the scooter rankings, that's a really good way to just see what's changed a lot. And you'll see something like Biogen. So a really interesting chart pattern, obviously some news-driven gap higher here and appreciating from 225 up to 310 overnight, which is a pretty big gap. I look at the distribution we had during the day, so really following the rest of the market lower. So that's not really the upside follow through you'd want to see. It's more of an initial reaction. Something like Lyft, has never, I don't think, been on the radar of nice up moves, but today for the first time, sort of a nice rally out of the lows. So potentially establishing a higher low, certainly a name you want to pay attention to see if it is able to build some momentum. But also remember, if you look at the top of the scooter rankings, these are stocks that have been continually strong. And a lot of the home builders have been up there. PHM, Pulte Homes just appeared on the list of big rallies. You can see the nice continuation. It's been in a nice uptrend, but a nice follow through today, up over 3% on a day when stocks sort of closed lower. Now extremely overbought with an RSI above 80. Usually that means after a little bit of a pullback, there's enough momentum to keep a stock like this pushing higher. So if you were surprised by any of these tickers that we brought up, any of the big names, go to your member dashboard and hone in on the scooter reports. Look at the names that are up at the top of the rankings, also the ones that are up and down a lot for today. And that'll tell you the things that are moving. Those are the stocks that, from a technical perspective, you should certainly be familiar with. So that's our market recap today. We're going to dig in a little more into sectors a little later in the show. So I didn't go too much into those, but so overall, definitely more distributive. So let's get to some additional thoughts here. On the next segment here, I want to open up the Final Bar Mailbag. So as I mentioned in the introduction, if you email us, thefinalbar@stockcharts.com, or hit us on Twitter at Final Bar SCTV. We love to get your questions and like to address them on the air as much as we can. We actually had a number of questions on sector relationships and relative performance. I'm going to wait on those until our next segment on sectors because that'll be more applicable there. But just a couple of questions we've received in the last day or two. First was on the S&P 500. Someone said the S&P 2008, the 2008 level, I think 3008 is what you said, was a 20% gain from the 2018 low. So basically, year to date, that would be over 20% gain. It's a huge resistance level, and you're right. The key right now is we're facing significant resistance. I think that's true. The fact that it's a 20% gain from last year, I don't think is as relevant as the key levels, right? So how we trade relative to those important resistance levels that so many institutions are going to watch and pay attention to. So for me, the real key levels are the 3020 to 3030. That's sort of the resistance we had in July and August. We've obviously failed now twice around those levels. Arguably today, if we get the follow through that I would expect, which is a little short-term weakness into the next couple of days, that might actually make this more of a triple top pattern with successively lower highs, which really is more destructive than constructive. But thanks for the question on resistance. And again, the percent gain is less of interest to me. I don't see people honing on that value as having as much importance as the price levels, right? As the meaningful price levels. Next question was on small cap outperformance and was asking, how do we think about small cap outperformance versus underperformance related to the market approaching all-time highs? I'm going to bring up a chart here and then I'll show you why it's so effective. Here we go, capped here. So this is looking at the S&P 500 in black, the mid-cap index in red. The IGR is the small cap ETF. And then here we have the micro-cap ETF in sort of the dark blue at the bottom. And that's in order how they've performed from the low, the market low at the end of December. So the S&P up the most, almost, just over 29%, down to micro-caps, which are up 16% over that time period. So quite a range, a dispersion between those four indexes, those four ETFs over time. So the question was, how do you think about small cap outperformance? And I think the question in particular was just looking at the far right side of the screen here. After the first week in October, everything sort of turned and accelerated to the upside. Small caps really accelerating even more than the S&P 500. So does that mean that outperformance suggest overall, market strength, that this is a good thing? So I would say, potentially in the short term, in general, when you see small caps, micro caps outperforming, that suggests more of a risk on positioning, suggests people that are being more speculative, going to smaller, less known companies, trying to, get the juice in their portfolio for the next ride higher. That's all true. However, I think you want to look less at that short term and I think more of the long-term trends. And one of the challenges we've had with this market is not just the fact that small caps overall have lagged. So if you look, the S&P 500 up the most year to date, whereas something like, the small cap index, about 6% or so, underperforming the benchmark. So, and again, that's just from the December lows of last year. But looking at that window, the fact that the mega caps, the largest companies have led over that longer term time frame, over the longer term trend, maybe the cyclical trend, I think is what's more compelling. So the short-term movement that you've seen with small caps accelerating, I would want to see that strung into more of a longer-term trend, right? So more and more time where small caps continue to outperform, that would be a little more encouraging. At this point, it's really been the largest companies. It's been a lot of the more defensive parts of the market, something like real estate. And again, in general, that tends to be suggest more defensive posturing than offensive. One of the things we've looked at a lot is consumer discretionary versus consumer staples, which again suggests more of a risk-off positioning, especially within consumers. So thanks for the question on that one. Very relevant to this exact chart, another question we had was related to stacking chart. How do you actually show multiple charts on StockCharts.com? So I'll show you two ways. This is the one way you can do it, which I'd consider maybe a stacked chart. Here I'm looking at the S&P 500 in the top, and then the next panel is the NASDAQ composite. That's actually pretty easy to do. Just create a chart of the S&P 500, make it a closing price, which will make it a line like that. At the bottom, just add an indicator called price and put in the ticker of what you're looking for. And that will allow you to do these two. They're on separate scales, so you're really just looking at the patterns between the two and seeing if they're in agreement or disagreement. So if you're looking for two markets and how they are confirming or not confirming each other, so something like this, or Dow theory, looking at the Dow industrials and transport reports, this is a really good way to do it. Now, the other thing you can do is if you overlay all four of them on top of each other, that's what I did on the previous chart I showed you looking at the cap tier ETFs. To do that, what you want to do is do a regular chart again and do it on the closing line. In this case, I'm doing performance because I wanted to look at relative performance. So I did a performance type chart instead of like solid line. I did performance at the bottom of the list. And then I just added 3 more indicators, and it's the price dash performance indicator. Put in the ticker. And then here, this is the key. What you want to say is behind price. And what that does is it'll stack everything you put there behind the original ticker, put them all on the same scale. And that's how I'm able to show on here, I want the specific starting point and then look at the performance relative to that starting point. So that's how you do it. If you're not familiar with that, look up Chart School on how to do multiple securities and you'll find some examples there. The last question we have is a really, really good one. We're not going to have enough time to really get into it, but I'll do my best very quickly. The question was on adjusted versus unadjusted data. And we might do a longer session on that. But basically, when you type in a ticker on StockCharts, you're looking at adjusted data. What that means is it adjusts all the historical prices for splits, which most people pretty much are comfortable wanting to do. But it also adjusts it for dividends. Because what happens is when a company pays a dividend, the price actually comes off. It actually deducts some value from the price and pays that value out as a dividend. So if you don't adjust, if you look at unadjusted data, you're going to have these little pullbacks, these little gaps, which show you the adjustment that you had to make because of the dividend paying out. It's actually a capital change for the company. The reason why the default here is adjusted data is because we want to show you, and this was based on conversations with John Murphy, years ago when they were first creating this, when Chip was first designing this. He said that adjusted data is the best illustration, the best visualization of the pure supply and demand. We want to take the impact of dividends and things like that out of the picture and just look at the fear and the greed, the emotional state. And so adjusted data is the best pure way to see the emotions on the chart, to see the supply and demand picture. If you do want to unadjust the data, no problem. Just put an underscore before any ticker. It'll show you the same series, but take all the adjustments out. So now you're going to see little things. And if you look at relative performance, you'll see the number can be very different, especially if you have a stock that pays a heavy dividend, like something like AT&T. I hope that answers your question about adjusted versus unadjusted. Maybe in a learning session in a later show, we'll dig into that a little further because it's something worth thinking about in terms of what you prefer and how you have your system set up. We're going to take a brief commercial break. We're going to come back with sector setups. We'll see you in a minute.
Today's market volatility provides savvy traders and active investors with an abundance of profitable opportunities. At the Traders Expo Las Vegas, November 7th through 9th, over 75 of the most respected traders in the world, including Dennis Gartman, Tom Sosnoff, Todd Gordon, and Tom DeMark, will explain how they're adapting their strategies and share the specific trading opportunities they've identified in equities, options, forex, futures, cryptocurrencies, and more. Claim your free pass to join them at tradersexpo.com.
Hello, everyone. Welcome back to the Final Bar. This is your host, Dave Keller, here in Redmond, Washington. A very rainy Redmond. I'm told while we were recording the show, one of the very few bridges connecting my office to my house has now flooded over. So the moment the Final Bar is resolved, I will be heading out to rejoin my family out there in the flooded lands outside of Seattle. But I hope you are having good weather wherever you're at. Next session here, we're going to talk about sector setups. All right, this is something we like to do with some regularity, sort of take a step back, focus on the sector movements. And again, the way I think of the equity markets, a lot of the best stuff you can do is on a bottom-up basis, right? So looking at individual stocks. And a lot of times we get really caught up in the S&P or, some broad ETF, some broad index, and think of that as the entire stock market. And you certainly can gain exposure with a lot of passive products. But if you look at individual stocks, that's when you really sort of get underneath the hood and start to understand a lot more about the dynamics that are causing the movements in the index. There are a lot of opportunities, opportunities for alpha or for outperformance. by individual names, by groups, by all the themes that sort of emerge when you look at individual stocks. So we probably talked about it every weekend. I go through the entire S&P 500 and look at every one of the charts just to see what the patterns are and make some notes and make sure I've not missed any of the big key movements. But another part of that exercise, I think, of being a holistic equity investor is looking at sector rotation and paying attention to sectors and groups, thinking of the market from that perspective, because there are a lot of interesting things that can come out of that as well. The way I like to do it is start with the relative rotation graph, the RRG chart. We're not going to go too much through the construction of this, but if you're not familiar, look at Chart School or look at some of the videos or Julius DeKempener's show because he does a really good job of using this to illustrate sector rotations. But essentially, we're rotating around the benchmark in the middle. So in the upper right corner, you can see utilities, real estate, and then consumer staples. So furthest to the right means it's been the strongest performing sectors. So these have been over here for a little bit now. It's been a rotation away from technology, from consumer discretionary. A lot of the sectors, defensive sectors rotated up here. What's happened in the last couple of weeks, you can see this sort of hooking around where utilities rotating lower, real estate rotating lower. And the fact that they're still furthest to the right means they're still the strongest relative performers. The down move just suggests that the momentum has come out of it. So they're outperforming on a much lesser and lesser degree. When they start to come down and rotate into the weakening quadrant, that's visually when you want to revisit those and think, is it really, is the trend really changing? So with consumer staples, it's rotated now into the weakening quadrant again over the last week, suggesting that, there's rotation away from consumer staples into other places. So while that's happening, what is actually improving? Well, things like technology had been hooking higher, now reversed a little lower with a lot of the big cap names in tech sort of suffering. The XLC communication services, a lot of names, Facebook and others that have struggled a little bit are rotating down here. Consumer discretionary, very interestingly, has rotated more positive, continued in that positive direction. Also, the XLF financials, which have actually now appeared in the leading quadrant. So some interesting moves with a lot of those. One of the questions we got on the mailbag was about consumer discretionary rotating into the leading quadrant. I think Julius mentioned that in his show. So what he was looking at was the daily data. So you can look at it on a weekly or a daily basis. I tend to stick with weekly because I'm trying to just think about that secular time frame, that longer term time frame, not to get too caught up into the noise. But if you're thinking more of the short term mean reversion, the daily RRG can be really helpful as well. And so if you think about it, this is now showing you a much shorter term time frame. It's looking at the last 5 days. Here I can see technology rotating weaker, real estate, staples, utilities, all kind of coming off as something like consumer discretionary has now emerged and gone in that leading quadrant. XLF as well, with all the banks kind of rotating higher. But again, for me, I tend to use RRG more of like the higher level 30,000 foot, what's been happening. So sort of orient myself that way. So for me, the weekly view, really showing the defensives on the right, but showing the rotation lower and a potential sort of reversion there is really sort of important. I then like to look at the sectors here as a candle glance page. Whoops. Sorry about that. As a candle glance. And the reason why I like to do that is to look at the individual charts and just look at where they're all at relative to those key moving averages. So what is in a bullish configuration above resistance, above upward sloping moving averages? Only a couple that I think you could describe that way, utilities and real estate, sort of jump out at me. So those are the two that are sort of long and strong up and to the right. And then you have a lot sort of in this secondary category, which has had a nice run, but is now sort of in a sideways mode. So something like staples, communication services, discretionary, technology, industrials, all sort of fit into that bucket. And then the last one is what looks kind of bad, what looks like it's below the moving averages. Energy is the only one that's really been in sort of a negative configuration. These are not on a relative basis. This is just pure price patterns. But in the case of a market correction, if the market starts to sell off, I like to see how many of the sectors remain above like their 50-day moving average and how many of them start to break down. So most of the sectors, everything except for really energy now has rotated back above its 50 days. So all of them are above the 50-day moving average, which is noteworthy. But again, if we do sort of get a pullback, it'll be interesting to see if any of these sectors pull back below their 50-day moving averages. That would tell you that something might have happened. The next thing I do is look at the sector summary. This is off the main page. It's off your dashboard. You can get to this. And if you look at the scooter rankings, this is a ranking based on the ETF. So it's looking at these ETFs versus all the other ETFs. So it's not just looking relative to other sectors. It's looking relative to all the other ETFs that you could buy, which is a lot of different asset classes and so forth. But if you look, it's sort of similar to what we've seen so far. So real estate, utilities, some of the strongest ETFs just on a price basis recently. Down at the bottom, you have materials, you have energy, which has certainly been one of the weakest ETFs out there. Communication services, very noteworthy down here, in my opinion, because a lot of those names, things like, again, Facebook, others that, had been sort of the bellwether FANG names, really starting to show weaker patterns relative to a lot of the other charts out there. And that's why they're sort of popping down into the bottom part of it. Then the last thing I'll do is sort of bring up the industry summary. So this is now taking the S&P sectors, but going down a level, looking at the industry level. Here we're using the Dow Jones industry groups. And it's just a great breakdown, sort of showing you each of these different buckets. So within each sector, you can get a sense of what's sort of driving things in the short term. Now, again, we're only looking at the percent change here on this page. So it's really looking at the short-term movements. But it's a great way to sort of break down the industries. And if you see something like media that's popped up a little bit today, or recreational products that popped up and led to consumer discretionary, if you click on it, it'll show you all the stocks ordered by performance. So here I'm seeing which names are at the upper end of that list, and I can go down to see which names have been a drag on that group. A lot of times you just want to focus on the largest names, which you can click on that column, which basically sorts it by market cap. Garmin's the only S&P name that's in that industry group, so you can see where that is, and you can click on the chart to look at it. You can also sort it by scooter ranking, which is a really good way to see which stocks are leading. So something like Polaris, which might not have been in your radar beforehand, this is recreational products, and you can see how the chart overall relatively sideways, but look at the jump to new relative highs now, almost to new relative highs for the last year. Looking at the May high there would be the indication, but now testing the highs from May. So if we're able to get above there, it's obviously a huge up move, almost 11% at a time when the market was relatively weak. Can be pretty interesting. So overall, that's sort of the sector picture. I see if you look at the average sector, it's holding up fine on a price basis. My concern is sort of the overall strength of some of the defensive parts of the market. And that's a theme I would want to continue to pay attention to. I want to finish off today by looking at the 3 and 3. And again, at the end of every show on the Final Bar, we like to look at 3 charts in 3 minutes. I often give myself less than 3 minutes, which I have successfully done so today, but I will go quickly through them. And again, if they're not on your radar, I'd encourage you to take these, recreate these, save them to a chart list, pay attention to them. So the first one is the XLF. We've had such a nice move from a lot of the banks, things like JP Morgan, Citigroup, a lot of companies that were reporting last week, have had nice runs and nice jumps on earnings. And so the question is, can the XLF get above resistance? I've had this line on the chart. This is the high from last September, and that's where we lined up with in July, also in September of this year. And now we've tested it again. We rallied above it yesterday, now back just right at that support resistance level at the close today. I sort of put this rectangle. This is an old Arthur Hill trick, sort of giving you more of a range as opposed to a particular level. So now we're looking at the peaks back in last February, last March. Sort of this range, this sort of overall range, 2850, 2875, you'd want to see the XLF get above there. And if you do, that means the big stocks like JP Morgan, Goldman Sachs, others have had enough of an upside follow through to suggest further upside. So that's a chart I'd certainly suggest you watch. At this point, it looks like resistance is holding. The second one is airlines. Airlines have been a very forgettable group, and I think a lot of people sort of wrote them off mentally in August when they sold off so severely. You can see the relative performance coming down. Look at how the Fibonacci retracement ended up being really key, looking at the August sell-off and how we came right back up to that level. We've now broken back above that resistance, and now just in a nice, slow and steady run. Stocks like ALK reported and did really well. Alaska Airlines. Look at the relative picture and how that's improved. So now you have a stock or a group that's performing well on a price and a relative basis. Certainly should be on your radar, and I'd be looking for how it does leading up to these highs around 110 on the XAL. Finally is momentum. So I'm always looking at themes and seeing what is changing, what might be a little different, and what you might not be prepared for. The fact that the momentum factor sold off so quickly at the beginning of September, then recovered, and the next couple of weeks actually looked just fine. We've had a resumption of that downtrend, and that momentum factor ETF is essentially following stocks that have been working. It's betting on strong trends to continue. The fact that this is rolling over, it means a lot of those growthy names that would have been part of that have sort of rolled over, as some of the more conservative, more defensive parts of the market, like AT&T, others, have emerged as more leadership. So as that goes down, that just means if you're stuck in the wrong names, I'd certainly be paying attention to stops, be paying attention to the types of names you're looking at. And if you're not screening for value ideas, it might be a really good time to do so. So that's the 3 and 3 for today. Want to appreciate so much all of you for joining me on the Final Bar today on October 22nd. You can email us any questions. We'll look forward to answering them in a future mailbag session, the Final Bar at StockCharts.com. You can also get to us on Twitter at Final Bar SCTV. And if you haven't checked out our YouTube channel, please go ahead and do that. Look for the StockCharts page. We have all the old shows, all the interviews there. For the Final Bar, this is Dave Keller. Have a good night.